Welcome to the Deep Dive. Today, we're really getting into the weeds on the third quarter 2025 results from a true giant of industry. Their performance is often like a global thermometer for heavy industry.
It really is. And what a fascinating quarter it was, because on one hand, you look at it and it's just this story of massive success. They actually hit two major all-time records.
Wait, two. Okay, tell me which ones.
Yeah.
Was it purely sales or was the pipeline, the order book, even more impressive?
Both, actually. Sales and revenues clocked in at a record $17.6 billion. That's up 10% from last year. But, I mean, the really striking thing, their future work, the total backlog, it jumped sequentially by $2.4 billion.
Wow.
To an all-time high. We're talking $39.8 billion.
Okay, that's huge. Almost $40 billion in backlog. That sounds like, everything's firing on all cylinders. 39% growth in backlog since Q3 last year. So here's the big question then for you listening, and really the core puzzle for us today.
Right.
If volume is hitting records, the order book is overflowing.
Yeah.
How on earth did their adjusted operating profit margin actually fall? It went from 20% down to 17.5%.
That's the paradox, isn't it? That's what we need to unpack. So our mission today is figure out what's driving that incredible volume. And here's a bit of a spoiler. It involves the digital economy in a big way.
Interesting.
And then we need to isolate what's really hammering the profits. And that seems to be these multi-billion-dollar tariff headwinds. #tag, the data center boom drives the backlog.
Okay, let's start with the good news then. Where's the demand coming from? Sales to end users were up, 12% overall? Pretty solid.
Well, yeah.
But the real story, the surprising strength, came from the energy and transportation segment, ENT, they call it.
Right.
Sales to users there.
Yeah.
Just exploded, up
Right.
25% year over year. And that was like double-digit growth across the board. Oil and gas, industrial transport, power gen. Okay, hold on. Power generation. That number leaped out at me from the report, up 33%. Why is this, traditional heavy equipment company seeing such a massive, almost sudden boom in electricity generation?
Well, this is exactly that collision of economies we talked about, that huge growth. It's pretty much entirely driven by the global hunger for AI and digital infrastructure.
Ah, okay.
We're talking about demand for their big reciprocating engines, primarily for powering data centers. The digital world, it turns out, needs a ton of physical, reliable power, and this company's right there supplying it.
That suddenly makes that record backlog make a lot more sense. That $2.4 billion sequential jump,
Yeah,
mostly power gen orders, and you mentioned oil and gas too.
exactly. Those were the main drivers for that backlog increase. But, this kind of explosive demand, it creates its own problems, right? Operational stress.
Like what? Can they keep up?
Well, they mentioned on the call that lead times for some key components, like their solar turbines, which are used a lot in these ENT applications, they're starting to stretch out, especially for the bigger, more powerful models. They named the Titan 250, the Titan 350. So they're currently juggling, prioritizing orders while seriously looking at needing a probably quite significant long-term capacity expansion. #tag regional variance and construction momentum.
Okay, so ENT is on fire, maybe even overheating slightly with those lead times. Does that kind of intensity carry across the whole business? Or is it a different story when you look at, say, their classic construction equipment business?
It definitely varies. Construction industries, CI sales to users there were up 7% overall, which is decent, but the regional picture is really mixed.
So.
North America was actually surprisingly strong, up 11%. That was, I think, better than they'd guided for.
And what's driving that in North America? Is it just housing or?
It's a bit of everything, it seems. Residential construction, non-residential, and also, importantly, those big infrastructure projects starting to kick in.
Yeah.
Stuff funded by the IIJA, the Federal Infrastructure Act.
Right, the infrastructure bill money finally flowing.
Seems like it. And that strength in North America is kind of masking weakness elsewhere.
Okay, where were things softer?
Asia Pacific was the main one mentioned. Sales declined there, performed below expectations. Just general regional softness, they said. China showed a little bit of positive movement in the heavy excavator market, the over 10-ton machines.
Oh, okay. A turnaround there?
Well, sort of, but it was apparently coming off such a low base, it didn't really move the needle much for the overall regional picture. Still pretty muted.
Gotcha. And quickly, the resource industries, mining, the huge stuff,
Far Eye was slightly above expectations, up 6% in sales to users. They said that was mostly just timing, getting deliveries out the door to mining customers.
Okay. And dealer inventories, are they building up stock?
Total dealer inventory did increase from Q2 by about $600 million, but they pointed out that the machine dealer inventory, part of that, which was about $300 million, was pretty much exactly what they expected. So no red flags there, it seems.
All right, let's get back to that paradox. Record volume, record backlog. But operating profit actually dropped $95 million year over year. Down 3%. What's the main culprit killing the profitability?
Yeah, this is the tough part of the story. The biggest single factor was a massive increase in manufacturing costs, unfavorable by, get this, $686 million.
Whoa, nearly $700 million in one quarter. Just in extra costs.
Just an extra cost. And they were pretty clear this was overwhelmingly, their word, attributed to the impact of higher tariffs.
Okay, tariffs, we hear about them, but that's a staggering number. Can you quantify that impact a bit more? Like, what did it do to margins in specific areas?
They gave some pretty painful specifics. The net hit from these incremental tariffs in Q3 alone was right near the top end of the $500 to $600 million range they'd estimated just for the quarter.
Okay.
And to give you an idea of the damage, look at the construction industry segment margin. Just that one segment took a hit of around 340 basis points.
3.4 percentage points, just wiped off the margin by tariffs.
From tariffs, yeah. So that core construction business profitability is getting seriously squeezed by this, and that's just Q3.
So what's the outlook for the rest of the year? Does it get any better in Q4? Or?
Afraid not. Quite the opposite, actually. Their estimate now for the full year, for 2025, incremental tariffs are expected to cost them somewhere between $1.6 billion and $1.75 billion.
Billion with a B.
Billion with a B. And the forecast suggests that Q4, the quarter we're in now, is actually going to be the peak headwind. They're estimating $650 million to $800 million just in Q4 tariff costs.
That's unbelievable. It almost sounds like they're being penalized specifically because they manufacture so much in the U.S. I mean, they have, 65 locations, 25 states, 50,000 employees here. How do you even react to that kind of hit when your supply chain is so, American?
It's incredibly difficult. They mentioned, short-term actions, cost cuts where they can, some limited sourcing changes. But fundamentally shifting a supply chain that massive, that domestically focused, it's not something you can do quickly.
Yeah, I can imagine.
Especially for a company that's a net exporter. It's complex.
And tariffs weren't the only headwind, right? There was a tax thing, too.
That's right, yeah. A smaller impact, but still notable. Their estimated global effective tax rate for the full year went up. It's now expected to be 24%, up from, I think, 22.5% adjusted rate last year.
Why the jump?
Mostly due to changes in U.S. tax law, specifically around how companies have to account for research and development expenses now. R&D expensing rules changed. Hashtag tag financial health and forward look.
Okay, so major cost pressures from tariffs, a bit from taxes. But despite all that, the underlying financial health, the cash flow, it still looks pretty solid.
Oh, very solid. Yeah, the machinery, energy, and transportation free cash flow, MENT, hit $3.2 billion just in Q3. That was actually about $500 million higher than last year.
Impressive. So they're still generating plenty of cash.
Definitely. They returned $1.1 billion to shareholders in the quarter, mostly dividends, about $700 million there. And they still ended the quarter with a really strong enterprise cash balance of $7.5 billion. So, yeah, financially very sound.
So putting it all together for the full year 2025.
Yeah.
What's the final outlook? Strong volume, tariff pain. Where does that leave them?
Well, they nudged up the top-line forecast slightly. Full-year sales and revenues are now expected to be modestly higher than 2024 was, so the volume strength holds.
Okay.
Cash flow, as we just said, very strong, expected to be above the midpoint of their usual $5 billion to $10 billion target range, but the operating profit margin.
Ah, here comes.
Yeah. The full-year adjusted operating profit margin is now expected to land near the bottom of their long-term target range. And they specifically said that forecast includes the huge tariff impact.
So hitting the volume, generating the cash, but the profitability target is under pressure because of those external costs. Looking just briefly ahead, maybe into 2026, is there any relief in sight on the cost front? You mentioned something about price realization flattening out.
Yeah, that's one potential positive, relatively speaking. They expect price realization, the benefit they get from higher prices compared to last year, to basically flatten out in Q4.
Why is that?
Because they're starting to lap the big price increases they put through last year, meaning the year-over-year comparison gets easier. So that particular pressure point, needing to constantly push prices higher, might ease off.
Okay, so maybe less pricing headwind going forward.
Potentially, but unfortunately, those massive tariff costs, they're expected to stick around and continue to be a significant headwind well into next year.
Right. So wrapping this up, it's this really stark contrast, isn't it? You've got incredible demand, record orders, particularly driven by this almost surprising data center boom,
Absolutely.
keeping the factories humming. But then you have these external policy factors, the tariffs, just hammering their profitability, especially in core segments. Record sales, but margins getting squeezed hard.
Precisely. And what's just fascinating, I think, is seeing this direct collision. The old industrial economy selling massive machines for digging dirt and building roads, meeting the new digital economy head on. That $39.8 billion backlog isn't just bulldozers anymore. It's, in large part, the physical infrastructure needed to power the global AI race.
That's a great way to put it. So given that dynamic and those lead times you mentioned for the big engines like the Titan 350 stretching out, plus this apparently relentless demand from power generation, here's the final thought for you to chew on. How fundamentally might this need for potentially rapid and massive global capacity expansion reshape this industrial giant's entire way of operating in the long run?